Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin this hour with stocks steady, ahead of fresh inflation data at 8:30 Eastern Time. Victoria Fernandez of Crossmark writing, we have witnessed a definite shift from the animal spirits driving markets to a new all-time high just a few weeks ago to now an increased probability of recession becoming the topic of conversation. Victoria joins us now for more. Victoria, welcome back. A week away from Liberation Day, early next week, that's going to be the big focus for this market. It feels like you've changed your view on things. What's changed?
Well, I think it's actually kind of what you guys were talking about. It's that sentiment of the consumer. When we look over the past year, we kept saying there's so many red flags that tell us we should be in a pullback, we should be in a recession, but the consumer was always there. We talk about a Fed put or a Trump put, but really it was the consumer put for the longest period of time. That's what has changed now. We see the consumer, and you guys have already talked about it this morning, all those companies coming out on their earnings, on their conference calls, talking about the concern that they're seeing. Lululemon being the latest example. I mean, I thought my kids alone would help support the numbers at Lululemon with their purchases, but apparently it is not enough. And the consumers are starting to pull back, and you get in that negative feedback loop. As the consumers start to pull back, revenues come down, margins start to get affected. What happens 9 months after margins get affected? Companies start laying off. And we've seen that with the Challenger layoffs in the last month. And so I think it's that consumer element that has changed that's giving us more concern, especially with potentially more tariffs coming.
How much is this company's kitchen sinking it, though? You mentioned Lululemon, and your kids would single-handedly cause this share to go up. But a lot of the kids are actually getting baggy stuff right now, and that was something they addressed, that actually the styles are moving past that sort of trademark legging spandex look. I'm just wondering, how do you parse through how significant the hit is and how big of a slowdown you have to price into market expectations?
Yeah, I mean, it's going to be different for every company, and the companies that have been out there talking about the slowdown have been along a wide range. It's not just apparel, right? We saw Best Buy as one of those. Yes, there was Nike and Lululemon, but you see Walmart, which is a different cohort of a consumer. And I think part of the issue, Lisa, is that it's not just the low-income and middle-income consumer anymore. We've talked for the last year and a half on that high-income consumer really supporting that economy and continuing to spend, even if they shifted their spending habits. They went maybe from a higher element kind of store, now shopping at Walmart. We saw Walmart gain a lot of share, but now they're talking about even the high-end income consumer pulling back. So I think you have to take that longer-term approach and say, as we go through this year and consumers start to pull back as they're worried about their jobs, and we see that in the quits rate coming down, we see it with hiring rates slowing. That's the element you have to look at to determine what does growth look like if that consumer engine is not there driving it.
Peter Cheer earlier told Bloomberg TV that the U.S. is trading trade flows for capital flows, and the rest of the world is going to outperform. Do you look to the rest of the world ahead of Liberation Day because you're really unsure about what is going to happen here in the United States?
Yeah, I think the rest of the world, we've heard from plenty of leaders around the globe talking about the concerns and already trying to make steps beforehand. We've seen it come out of India. We see it come out of some of the European countries where what can we do and before the idea of reciprocal tariffs come to lower that rate? What can we do to help our consumers? We saw inflation this morning out of Europe actually come in lower than expected and ECB rate cuts moving higher. So you have to look at it and see what are rates going to do between the two. What does it look like on exchange rates? International has done much better because of the concept of growth continuing, especially in Europe, with the steps that Germany is making in defense. But has some of that already run out? Is that already priced in to the European market? So I might wait for a little bit of a pullback on international before putting my toe in the water if I haven't already, and let that consolidate a little bit before going there.
Victoria, this is not the only headwind for markets. In fact, the dominant headwind has been the pain trade. And the pain trade's been tech so far in 2025, stateside. Let's think about the shots that's been fired at tech over the last week or so. Reports that Microsoft is pulling back on data center spending. Alibaba firing shots about overcapacity and bubbles. And then overnight, a heavily downsized IPO from CoreWeave. How constrained is the AI trade at the moment?
Yeah, I mean, no one likes that word bubble, but there is a lot of questions now going into hearing all of the money, the CapEx spends that companies were going to do in regards to AI, seeing some of that pull back. You mentioned Microsoft as a perfect example of it. And what does that mean going forward? I think, look, tech, as we went into this correction, tech had already pulled back. They haven't become leadership during this correction period that we're in. So I don't think we should look to tech to be the leaders coming out of this correction. I think they're going to continue to struggle because of some of the headlines that you've mentioned. Maybe you start to look at some of the secondary companies that will benefit from productivity enhancements from AI, and not necessarily the tech names, the data warehouse components of it that people were really looking at. We've seen utility sector pull back a little bit as well because of the headlines that you're mentioning. So I think we continue to see some struggles in tech, and you're probably going to have to look at places like healthcare, maybe certain types of materials, financials. These are the sectors I think that will lead us coming out of the correction that we're in. That's where you should probably focus.
Can you walk us through how all of these prongs of sentiment hits have translated into your view shift over how you should allocate your assets? And I ask this at a time when gold is at record highs and people aren't sure whether to go into bonds or whether to go into healthcare.
Yeah, well, I mean, look, you're talking to the bond girl here, so I would always recommend having some bonds in your portfolio. But people want to hedge what they're seeing. And when there's concerns around growth, gold is the hedge that people go into. When that's not the concern, when growth is actually looking like it might pick up, then you see people go more into industrial metals or things like copper. Copper's actually down this morning after having a pretty good run. Gold continues to move higher. So you see there's that concern around growth. We look at sentiment, and it's always important to break sentiment down and say what's driving that number. Is it the more volatile component of sentiment that's the expectations part, or is it the present situation that's driving it, that's usually more focused on jobs and fundamentals? We saw both elements come down in the last sentiment number. So there is maybe a little bit of support to that stagflation argument that people are talking about, as we have concerns around the growth component, which supports gold, and still have concerns around inflation and how sticky that's going to be. Obviously, we have PCE later today, but I think you have to look at sentiment and say this feeds into the story of a pullback, of the consumer pulling back, of growth concerns, of GDP concerns, at least in the first half of this year.
Since you're a bond girl, can you really say that bonds are going to have the same kind of buffering effect that they have traditionally at a time where inflation expectations are actually rising?
Yeah, I don't think you're going to go into fixed income right now and say, oh, wow, spreads are going to tighten. I'm going to get, a lot of a price return coming out of that part of the market. I don't think that's what you're going into fixed income for right now. I think you're going into fixed income to lock in some steady cash flow components in your portfolio. Some people may like to do that with dividend payers in the equity market, but that's a little more volatile. If you can lock in some steady cash flow on the short end and the long end of the treasury curve, it gives you a little bit more buffer in your portfolio, as we think we're going to continue to see volatility at least for the next 6 months in the equity side of the market.
Hey, Victoria, appreciate your take on things going into the weekend. Victoria Fernandez at Crossmark. Nvidia-backed CoreWeave raising $1.5 billion with a starting share price of $40. The firm initially seeking to raise as much as $2.7 billion ahead of its first day of trading later on today. Angelo Zino of CFRA joins us now for more. Angelo, welcome to the program. What kind of signal do you take from this heavily discounted IPO?
Well, first off, thanks for having me. But when we kind of look at this, I mean, we're not necessarily surprised by the discount here. And I don't think most in the market are necessarily surprised kind of in light of recent events and what we've seen over the last couple of weeks from just overall sentiment on the tech side of things, just, really kind of going sour. Overall, you've got these tariff macro issues out there and the implications that they're having on tech. You've got these obviously the deep seek concerns out there and the implications on the tech side of things there. I think also as far as CoreWeave is concerned specifically, when you kind of look at that business model and kind of how they handle the financing side of things, kind of being more of this kind of GPU infrastructure-backed lending type of company. I think that's a business model that really doesn't kind of, bode well with a lot of investors out there, especially amidst a period where kind of we've got a risk-off trade for AI right now.
It's a huge risk-off trade and has been ever since the DeepSeek revelations, Angelo. So let's build on that. It's not just that. Alibaba out this week. The chairman came out and said maybe there's some overcapacity, perhaps even a bubble. Then we had a report from TD Cowen that suggested Microsoft was pulling back from projects in both the United States and in Europe too. It's a question we asked earlier this hour, Angelo. Just how constrained is this trade at the moment?
Listen, I think when you kind of look at the sentiment out there, I mean, it's pretty negative. I mean, we kind of look at the hyperscalers out there from the likes of Microsoft, Oracle, Meta's out there declining anywhere from 15 to 25%. When you kind of look at the AI semi names out there, they've kind of declined more notably, kind of in the 25 to 50% range out there. So a lot of kind of the uncertainty out there, whether it's kind of what you alluded to as far as the Microsoft situation is concerned. And I think that'll be the most important event this earnings season is that earnings call from Microsoft. We really need to hear from them, find out exactly what their intent out there is. I mean, our view is it partly has to do with that OpenAI relationship, as well as the fact that, hey, listen, maybe and they clearly articulated the fact that they are going to shift more towards their server side of things and less towards the infrastructure side of things, which we think makes a lot of sense. We do like the Microsoft trade at this point in time, given the pullback. But there's a lot of uncertainty as far as all that is concerned out there. We think a little bit kind of to an extreme, and we do think a lot of those valuations are kind of baking some of that stuff into it.
To build on that, I'm kind of whipsawed here because it was just a couple months ago that we had people on here who were saying that truly these hyperscalers can't invest enough in infrastructure and that frankly the energy system and the infrastructure currently out there is nowhere near what's necessary for the AI build out as people imagine it. So which is it? How do you understand how much what we're hearing from China is fact versus fiction in terms of just how much technological advances transforms that story?
Yeah, no, I think that's a great question. And I don't know if there's an actual way to answer that, to be honest with you. But when we kind of look at it, right, I think DeepSeek did change things more than people kind of want to acknowledge out there. I think you kind of take a look at China, look at the efficiencies that they've kind of accomplished on their end of things. And then you kind of look at what's happening in the U.S. And I think kind of that's the bigger issue out there, because if you kind of look at the pace that these kind of hyperscalers are investing at, and now at a point in time, right, where we do have these tariff concerns out there, we do have those growth concerns out there at a point where we could potentially see some pressures on the top line, whether it come from some deceleration on the cloud side of things, whether it be some challenges on the digital ad side of things. That puts pressure kind of on these hyperscalers out there, not to mention these tariffs out there also increase the cost of kind of installing these servers out there. So these hyperscalers are going to have to look to be a little bit more efficient in nature. And in many cases, what we've seen here over the last couple of months is really going to force them to do that.
Is CoreWeave a litmus test for other potential companies that want to IPO this year in the tech space? Or is it idiosyncratic, and I hate to use that word, but special because of its connection, particularly to some of these areas that are part of the peak uncertainty?
Yeah, I mean, we personally wouldn't be using them as a benchmark for other potential tech IPOs and other IPOs in the market out there. Again, this isn't the name that we would potentially or would like to see as kind of that first name being thrown out there in this tech IPO market, kind of since the Trump administration has taken over. But that said, this is what we've got out there. It is going to be somewhat of a test out there. We'll see what the sentiment looks like. But in our view, no, it shouldn't kind of be used as kind of this test longer term or over the next 9 to 12 months in terms of what the sentiment looks like for tech longer term.
So Angelo, for you right now, top pick, what is it?
It's a great question. I mean, we've told investors over the last couple of months to continue to shift towards software over semiconductors. Now, we'd acknowledge that neither side have really kind of worked that well, but we'd say the lesser of both evils right now is still on the software side of things. We remain believers kind of on the side of things where you are going to see more M&A on that side of things. We also believe that kind of the fundamentals are also going to hold better on the software side of things. And for us, a name like Microsoft at these levels is a name that I feel pretty confident recommending to investors. I think Salesforce is another name which has seen a notable pullback as well, which is a name you can kind of be looking at these levels.
Angelo, appreciate the input. As always, thank you, sir. Have a good weekend. Angelo Zino there of CFRA. Senate Republicans working on changes to the House GOP tax plan, looking to require fewer cuts in Medicaid benefits for the poor and disabled. The move aiming to appease members of the party worried about public backlash. I'm pleased to say that a good friend of this program, a good friend of ours, the Congressman from Arkansas, French Hill, joins us now for more. Congressman, good to see you, sir.
Jonathan, great to be with you and Lisa and Anne-Marie. Always good to be back in New York.
Is it turning out to be as much fun as you thought it would be down in Washington?
Every day is a joy.
April 2nd, how much of a joy is that going to be?
I'm just glad it's not April 1st, because that would even increase the uncertainty even more. I mean, actually.
What are your constituents telling you about what's happening in Arkansas on the ground?
Yeah, look, on the relations to tariffs, about 30% of our output in Arkansas goes to Mexico or Canada. And that's food and manufactured goods and back and forth. And then you have the North American Free Trade Agreement, now under USMCA, that was crafted to make North America the destination for manufacturing. So for 30 years, it's been knitted together. And so I think the first thing that I'm hearing is certainty, and just lay out the plan on how you want to use tariffs to open up more markets for Americans, have reciprocity on fairness in certain markets that are highly disproportionate treatment, like India, for example. But when it comes to North America, let's renegotiate USMCA. If you want to limit certain inputs from China into Canada, Mexico, or the United States, you can do that in the agreement. Those countries can do that on an input basis. If you want to have the American manufactured content higher, you could negotiate to do that, as President Trump successfully did last time he was president on the North American auto content. He got more American content. So I think it's best to tackle this Canadian and Mexican issue inside a new and revised USMCA.
But USMCA was done under Trump. It replaced NAFTA.
Right.
So you want USMCA Part 2. Do you think that's what he's getting at, Donald Trump here, the president? He's getting at the start, bringing those 2026 talks up into the mid-2025.
Yeah, potentially. And I think that's not wrong thinking on his part. If you're concerned about Chinese dumping through transshipment of steel, for example, into Canada or Mexico, let's deal with that inside the agreement. Let's have Mexico deal with that in their own trade policy on inputs coming into the country. Because that's how I think you have a more robust, competitive international system where manufacturing is at the heart of America. I think President Trump strategically in trade diplomacy, I'd like to see more things made in America. That takes time to do. It's not overnight. We had steel and aluminum tariffs, for the past 5 or 6 years, and they haven't, been overnight changes across the board.
Walmart is headquartered in your state. They went to China and said, look, we're dealing with tariffs. You're going to have to eat some of this cost. And the Chinese are saying no. Are you concerned about the cost being passed on to consumers?
I am when I don't know what the strategy is. This is the whole point. You have trade diplomacy on using trade as a sanction potential, like you saw the president do on Colombia on repatriation of immigrants. You had trade used for reciprocity to bring down actual barriers that benefit actually both countries potentially over time. And we did that successfully for 40 years. We did it targeted. When I was in the White House working during the Bush administration, we used Section 301 to target bad activities by principally then Japan to open those markets doing this kind of tariff activity and limitation on imports to the U.S. So you can do do that in a classic trade diplomacy situation. But when you have across the board and it's not clear on what the time frame is for the increased production in the U.S., I think that's the challenging part.
But is it your sense when you speak to the White House that April 2nd is the start of negotiations, that at the end of the day, the president is a deal maker and wants to get deals done?
Well, I hear from my colleagues on the House, they want clarity like the American business wants. So you tell us what components and what timeframes you want to do trade diplomacy, you want to use reciprocity, you want to protect certain industries in the U.S. where you want to have achievable gains in production here. But when it comes to autos, which is the most important topic of the day, I think that's best done through advancing changes to the USMCA that President Trump led successfully with the Mexicans and the Canadians in his first term.
The market's also looking for clarity on all of Trump's proposals, especially tax cuts. The Senate, the Republicans, Eric Wasson, our reporter in Washington, D.C., is talking about how they want fewer cuts to Medicaid health benefits for the poor, disabled, which would be different from what the House is talking about. Do you think House Republicans, Senate Republicans can come to an agreement on how much can be cut?
I do. I think we'll come to an agreement. I think we can come to an agreement rather quickly on a joint House and Senate resolution for reconciliation so the committees can get to work. And I just referred to the Wall Street Journal story today talking about duplicate payments in Medicaid across the states and how large that number is. House Republicans are looking ways to improve Medicaid, focus Medicaid on the most vulnerable, the young, the poor, the disabled, and trying to wring costs out of the systems. Democrats, I think, in a political charge are, well, you're going to cut benefits for Medicaid. That's an assumption by Democrats politically.
Well, because the math doesn't work when you're talking about $880
and also,
billion.
that's the charge for the whole committee.
Right,
yeah.
but most of that money goes to Medicare, no?
Right, but look at the numbers, and I think that's what the House and Senate want to do. Let's get to a Senate resolution, and let's let these committees work to mark those bills up to find the savings that we can produce.
Besides the extension of TCJA, what other tax cuts do you think are actually feasible? The president has talked about no tax on Social Security, no tax on tips. Just this week, no tax on auto loans apparently is being thrown out there and he's flirting with. What actually can get passed?
Well, this is the beauty of the reconciliation process because the president puts his plan out there, his best ideas, what he wants to try to accomplish. And then the House and Senate have to come together and figure out what we can do in the context of that budget resolution. Can we find the cuts? Can we find the offset? Do we agree in the House and Senate on the economic forecasts? And so I won't prejudge what the possibilities are. I just know how hard the work is going to be. I want to put an emphasis on things that grow the economy. So if we have to narrow the focus on what amount of tax cuts we're going to have, let's focus on ones that produce production, more jobs, faster economic growth.
Do tariffs increase revenues and turbocharge growth?
Again, this depends on the strategy, Lisa. You know, you can have an across-the-board modest tariff that might raise revenue and not impact growth economically. But what is your goal? Is it reciprocity? Is it market opening in new countries? Is it level of the playing field, or is it increasing production in the U.S.? Those things are sometimes in conflict.
What number are you penciling in for the tariff revenue to offset some of the cuts?
Right. So in Congress, we're actually not penciling in tariff revenue because it's not counted by the Congressional Budget Office as an offset, which doesn't mean we can't count it. Like if there was a strategy and it laid out, the two budget committees could agree. We will accept some revenue from projected tariffs in the revenue estimates in the reconciliation package. But we're not, as of now, counting that. That's a hypothetical that we're actually not counting on right now.
Has Walmart been in touch? I imagine they must have reached out to you and other representatives of Arkansas. How upset are they about this?
Well, they want, I think, so many businesses, and they report on your broadcast on a regular basis, they can live with certain things if they know what the plan is. And so Walmart's concerned about the number one thing they think about every single day, which is the American family they serve, and they want to make sure that that can be done in an affordable way. That's their goal in life. So this could interfere with that. But we need to wait and see what the ultimate goal is.
Do you think the White House appreciates that? Because we hear this every single day, and we've said on this program, confidence coming into 25 was sky high. We wanted to see that sky-high confidence translate into hiring, into investment.
Right.
And the lack of clarity, the lack of certainty, it's really held things back, and you see that in the sentiment surveys now. Does the White House, in your opinion, sort of understand that?
the lack of certainty, the lack of clarity is holding this economy back?
I certainly think Treasury Secretary Bessent and National Economic Council leader Hassett know that. They're very experienced in economic policy making. And my view is you've got I think, clarity about right-sizing regulatory costs in the economy. You've got clarity about trying to reduce the bureaucracy in the government. You've got clarity on where we want to go on tax policy. We need an equal amount of clarity on the strategy in and around tariffs and increasing manufacturing here. President Trump's big picture point is a good one, but you've got to develop a workable strategy to do that. And I think that's what the role of the Treasury Secretary, the Commerce Secretary, and the National Economic Advisor, that's their principal mission.
Congresswoman Elise Stefanik is going to be staying put in Washington, D.C., not coming to New York to work at the UN. Do you think that's an admission by the White House that they're nervous about getting this tax bill done through Congress? They have the votes?
Well, it surprised me. I'll be candid. I think Elise was an outstanding member of our leadership team. We welcome her back to the Congress, but I also thought she was going to be an exceptionally well-trained and qualified ambassador for the president at the United Nations. It could signal that. I think President Trump's own quote says we need to make sure we have the votes in the House. So if you consider that an admission, we welcome her back. I think it says that maybe replacing her with a Republican they think might be tough in New York as a political strategy, which is that's been a red district. But you know, that may indicate that. And we need every vote we have. We have the most narrow margin. Mike Johnson has the most narrow margin since World War I. And so we don't want to have a gap there. And when we passed Tax Cuts and Jobs Act back in President Trump's first term, I think some 20 Republicans voted no. So we don't have the luxury of that this time.
Congressman, we always appreciate your time. It's good to see you.
Great to be with all of you.
Thank you, sir. Congressman French Hill, and also the chair of the House Financial Services Committee. To build on this conversation, I'm pleased to say that joining us now is the former St. Louis Fed President, Jim Bullard. Jim, welcome back to the program, sir. It's been a while. We haven't spoken to you, I believe, since Chairman Powell spoke in the news conference, so we've got to ask you. We need your reaction. The T word making a comeback at the Federal Reserve. What did you make of that?
It's not making a comeback with me. I'm not using that word. I think that I do think that the committee has good reason to stick with the policy rate where it is. Inflation expectations for the next 2 years in the TIPS market have been rising. They're about 3.25 today. That's a CPI-based measure, but if you put that over to a PCE-based measure, it'd be around 3% PC inflation over the next 2 years. That's what the market is thinking. That's too high for the committee. The committee's trying to get especially core PC inflation, which came in a little bit hot here. You're trying to get core PC inflation down to 2%. So they're going to have to be higher for longer. And if it goes too much farther, they're going to have to raise the policy rate.
Wait, hold on a second. Because, Jim, this is exactly what people thought that Fed Chair Powell did last week when he said transitory, the word that you will not go so far as to say, is that he would be willing on some level to look past tariff-related boosts to inflation in the short term, especially if growth was sagging, and that the Fed would have to or be open to responding to slowing growth. Are you saying that inflation, should it be above expectations because of tariffs and whatever else, it's going to be important to address?
The committee should be hitting their inflation target 2 years from now. And what the market is saying is, no, you're not going to hit it. You're going to hit 3%. That was my story here. So that doesn't sound very good to the committee. Now, maybe the market's wrong. They often have, and I'm talking about 2-year tips here, and they can move around, yes. But it's a good reason for the committee to stay where it is. I have argued that the committee's in good shape here. They didn't go as far as was previously expected on cutting the policy rate. So they stayed a little bit higher. I think that's turning out to be wise. The tariffs, when I say tariffs don't cause inflation, what I mean is that inflation's a product of monetary policy over the medium term, and it's not up to the trade representative to control inflation. It's up to the policymakers to control inflation. And they have to adjust policy appropriately given everything else that's going on in the economy. And so And over a 2-year horizon, that's something you should be able to influence. But right now, markets are saying the committee doesn't look tight enough to get down to 2% at the end of 2 years.
Jim, do you think that the Fed should open the possibility of hiking rates again?
Well, it's not my base case, but I think the probability on that is rising slightly here. And this wasn't that radical of a data release here, but I do think that possibility is rising. We really haven't made any progress on getting core PCE inflation down, let's say over the last year. I think the man on the street would look at those numbers and say, it's basically been flat for the last year.
Jim, one thing we've heard repeatedly from some economists is this labour market's just not as tight as it was. And because it's not, that dampens down the potential for second-round effects from the inflationary kick-up that you get from tariffs. What would you say back to that? How fertile do you think this environment is for second-round effects?
I don't know. Come on. Unemployment insurance claims, ridiculously low. That's your best week-to-week indicator. Unemployment rates, if anything, is probably below the natural rate for the U.S. economy, but certainly low by historical standards. I just don't see it right now. Now, there's fear of the future and what might happen, and we know that the last tariff war in 2018, 2019 did cause a slowdown in the economy, and that the Fed did react to that by lowering the policy rate. So we'll see if that history repeats itself here. So that it's the expectation that people might be thinking about. But as far as where the labor market is right now and whether that's disinflationary pressure coming from there, I don't think so.
Jim, can we have a best guess from you? Next move, cut or hike? What would your best guess be right now?
I still think the committee can stick to its baseline that there will be further cuts, but they're being pushed farther and farther out into the future. And now with a hotter core PCE year-over-year number, you might start pushing those out into 2026 instead of 2025. We'll see what the market does in the days ahead.
Hey, Jim, before you go, Boilermakers play tonight, don't they? Sweet 16?
Yes. And
you feeling good about that?
The victory for the Boilers here. We're playing in Indianapolis. I think they don't lose at home very often, so I think they've got a good shot.
Boiler up. I do that because you know the manager who does my reviews, Purdue. Appreciate it. Thank you, sir. Former St. Louis Fed President Jim Bullard. Jim,
sure.
Thank you.
It's why I picked Purdue as well.
Right.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.